My title slide pretty much sums up everything in my presentation, which is that right now, I don't think anybody knows what the hell we're going to end up with this year. Like it's really a coin flip. I'm going to go back and forth through some of the different data, but I honestly, I've leaned towards thinking there'd be a recession this year. Well, for quite a while, for a year probably now. But I have to say, even though I'm cynical about the soft landing crowd just because the Fed's never pulled it off before, I'm not seeing data yet anyway that implies anything but a soft landing. So who knows? Maybe they'll do it. And unusually, this isn't how I usually do things, but a couple of the new speakers that we had here at this show, I had some back and forth with them about disclaimer slides and stuff, which in all honesty, I don't bother usually putting in. The companies all do for reasons you all understand. But it occurred to me that maybe I should do that. So I got together with my crack securities team of lawyers, and they came up with a nice, short, succinct one for me. And you guys should keep all this in mind as we work through this. That's pretty much covers everything, and I think allows me to duck when I need to. Okay, so having got that out of the way, so you can just keep eating and ignore me from now on. Like I said, the macros, it's very confusing, but it's not random, I don't think. When I look at different macro data, there's a very strong dichotomy between hard data, and by that I mean things like, retail sales, whatever, employment numbers, things where you're actually counting something. And then, what's usually referred to as soft economic data, which is surveys, basically. And a lot of things that are traditionally thought of as being hard data by investors are actually survey data. Probably the best example of that is ISM, the ISM supply and manufacturing indexes, which have a very big influence on the markets. There are portions of that are kind of quasi actual measurements, but really they're mainly surveys, and they are surveys with a good track record, don't get me wrong, but I'm just saying there's a very strong divergence right now between soft and hard data. Hard data is basically saying economy's not great, but it's growing, it's kind of okay-ish. The soft data looks by and large terrible. Q4, we just got the GDP for the US a couple of days ago. It came in stronger than I think most people expected, 2.9. I didn't have a strong view in it, other than that I've been saying for months that I think all these people talking about a 2022 recession, that just never happened. There was not a recession in 2022, even though if you look at the official US numbers, they'll show you a 2-quarter recession. But I think that was partially big swings in inventory levels and stuff, things that aren't really growth and income related affected that. So, and as far as what happens here, I'm not clear on why there's so much divergence. I mean, I got a feeling it's mainly, if you had to pin it on anything, I think you can blame the Fed, I guess. I think it's all the rate increases after decades really of zero or close to it. I think it's just got a lot of people spooked, and they're assuming those rate increases, and it's a fair assumption, those rate increases are going to have some big negative impact. So whatever today's data is, the majority of people being polled in these forecasts are assuming things have to get worse because rates are at 4.5%. Now here's a couple of interesting charts. I mean, I call this the most predicted recession ever, which it is. The chart on the left is really quite amazing, really. That's a 50-year chart, and what it's showing you is essentially the percentages of it's made up of market forecasters, market strategists, economists at investment banks, but also at think tanks and universities, etc. They get polled constantly on what do you think growth is going to do over the next 12 months. If you look at where we were Q4 on the right side of that chart, that is by far the worst reading we've ever seen. Economists have never predicted a recession to the extent they're predicting it right now. Like, it's not even close. And remember, like I said, that's a 50-year chart. It's crazy. The chart on the right actually gives you some idea what I was alluding to a couple of minutes ago, and it's kind of interesting. There's 2 or 3 different measures here. So the people who put this chart together, they broke it down into sort of hard and soft, and by that I mean, again, measurements and surveys. That's probably the simplest way to break those two down. If you look at the hard numbers right now, it's not great. So yeah, like things are definitely slowing down, but it's projecting 0.5% growth going forward based on hard numbers. But if you look at the softs, I mean, they're predicting minus 3.4% growth. That's a really bad growth. That's a bad recession. Like minus 3.5 is a bad recession, not a mild one. I got a feeling the truth's going to be in the middle somewhere. I'm having trouble seeing, unless employment and wages really rolls over hard. I mean, really hard. I just don't see enough drop in income to generate something like this. But this is close enough to zero that, yeah, I still think later this year we probably get a recession. I'm not convinced it's going to be a bad one, but the problem with things like recession is once these things start, there's a bit of a snowball effect, and you just don't know until you're in it how deep it's going to be. You know, is there a bunch of follow-on effect? Is, you know, do layoffs beget layoffs, all that kind of stuff? You just don't know that until you're in it. So I still think we have a recession later this year, but I'm not expecting anything terribly dramatic. I think it'll be probably pretty soft. Now, do we get a, you know, of course, the follow-on from this, and this ironically is part of the reason why Wall Street is rallying, is you have this weird sort of change of mood in Wall Street. It's gone from, you know, like I showed you in that earlier slide, everyone predicting a recession. You're seeing more and more people kind of going, you know, I think we might just skate by it. It's not going to be negative. Maybe we get down to 0.5% growth or something, which might feel like a recession, but it won't be one. And the combination of that leads people to go, well, it's going to be bad enough that the Fed's going to pivot, Jay's going to cut rates, everything's going to be great. That's awesome. We're Wall Street. That's all we actually give a shit about is lower rates. Wall Street is all about liquidity, period, only all the time. They care about rates. They don't care about anything else. So they're happy. That's why Wall Street's rallying. And one thing that, you know, I've been a skeptic, and I'm still a skeptic. I still think Powell, it's not that I think he's going to jack rates much farther, like maybe does another 25 basis points next week. Maybe there's another 25 after that. I think it's kind of 50-50. But I'm not assuming he's going to cut very quickly after that. I could see him staying at, you know, 4.75 or 5 for months and months and months. Like they're very worried about not seeing inflation come back. But one of the reasons why, you know, there is actually some logic to Wall Street suddenly being more confident about a pivot is this graph is real interest rates. So it's interest rates less. In this case, it's the PCE, and PCE is personal consumption expenditures. It's the inflation measure. That's the inflation measure the Fed uses. They don't really follow CPI. They follow PCE. And when you subtract where the Fed funds rate is, PCE from that, we went through this period, obviously, you know, COVID, all that kind of stuff. It went hugely negative when everybody cut to zero. You had bonds at negative rates, stuff like that. That's turned around, basically, obviously, thanks to the Fed. So recently, we're actually back up into positive territory, and that's basically where the Fed wants to be. What the Fed's been trying to do for a year and a half now is get back into positive real rates and get back above what they consider the natural interest rate. And nobody really agrees on what that is, but the thumbnail that most economists go by is 2.5% rates that's considered natural rate of interest. Above that should be tightening. Below that should be loosening. So right now, the Fed's kind of where it probably wants to be. So if this continues, and it probably will, I expect we see a couple more lower PCE prints. So just holding the rates where they are, that real rate should get more positive. So it is possible the Fed just goes, yeah, let's just kind of sit back and see what happens here and see if this is the tightening we want. Ironically, though, because Wall Street is so happy, I could see the FOMC looking at what's happening with risk assets across the board right now and going, you know, in theory, we're in a tightening environment, but when we look at the markets and we look at risk assets, this is not a tightening environment. This is not what risk assets do in a tightening environment. So we're not so sure we should be slacking off and cutting rates that fast. Like, So that's one of the reasons why I think we're going to have high-ish rates for some period of time. I don't think the FOMC members are happy about seeing everything rally so much, because that, by definition, that means they're not in the tightening conditions that they want to be in. So, I would be careful about assuming we're going to see a big pivot that soon. And, interestingly, and of course, I'm sure everybody in this room knows about this because of the impact it has on all the metals that get explored for and mined by the companies that are here. Maybe counterintuitively, and it probably at first glance it seems counterintuitive when you look at this US dollar chart. I mean, it did pretty much exactly what you'd expect it to do with the Fed raising rates meeting after meeting after meeting. But once we get to the end of September, things plateaued out, and then they really started coming down hard. And that is kind of counterintuitive when you think about what's happened with interest rates, but there's a couple of reasons for that. Currencies, there's several reasons why they trade against each other. One is real rates by comparison between different currency regimes. The other one is growth rates between different currency regimes. And part of the reason why the US dollar was so strong was, the other big currency blocks, especially Europe, things were going to shit. I mean, Europe looked like it was going to hell in a handbasket most of the way through 2022. And it just looked like things were going to get uglier and uglier and uglier between Ukraine, energy, natural gas prices, or, they're all going to be freezing in the dark and we'll be chipping bodies off sidewalks. It got crazy. And then one of the things that helped it and helped roll over the US dollar and in turn helped gold. If you look at both these charts, the one on the left is the euro, and you can see where it bottomed. One on the right is the yen. You can see where it bottomed. Those are the two biggest currencies that trade against the US dollar, and they're the two biggest parts of the US dollar index, which is just comprised of cross rates. That's how they come up with the number. Europe got really lucky. I mean, no two ways about it. They got really, really, really lucky with the weather. Temperatures are running like 10 degrees Celsius, which is mind-bogglingly large number, higher than normal. They just haven't gotten the natural gas drawdown that they expected. And they managed to hold things off enough to get a couple of LNG terminals up and running. Natural gas rates have fallen off a cliff in Europe and everywhere else. That's been a huge boon to Europe. And suddenly, all these forecasters that we're talking about a 2023 recession and like a really bad one, like a 2008 plus recession, everybody's backed off of that. There's some people thinking now that Europe won't even have a recession. It will also have some kind of a soft landing. So that's why the euro is being so strong. Suddenly Europe's got the wind in its back. It's a little different for Japan. Part of why you're seeing this in Japan is Japan, and this is very un-Japanese-like, actually has had high CPI for the last couple of years. The inflation rate's actually high, and it's stayed high in Japan, which ironically is what the Bank of Japan was trying to do for 30 years. And they managed to happen this year, and they're running like 7-8%. A lot of traders in the market, a lot of the bond vigilantes are going, well, okay, the yield curve control is going to go now because inflation is this high and stuff. So far, the Bank of Japan head Kuroda is refusing to back off of yield curve control. He did have to broaden. Basically what happens in Japan is the way that they hold rates down, the yield curve control, what they do is they go in and buy bonds. That's how they bring the inflation rate down. Bank of Japan right now owns all of their 10-year bonds. I think more than all, actually. And bond traders thought, the bond vigilantes thought they could get them to roll over. And so far they haven't been able to, but part of the impact of that is selling bonds, traders selling bonds, driving up yields. That brings down the yield differential between Japan and the US. And Japan, understand, is a huge funding source. Like you think of all these hedge funds and stuff like that, where did they get their money? That's where they get their money. It comes out of Japan. The years and years and years of 0.2, 0.1, point nothing interest rates, that's where those guys would go to borrow money that they were using to speculate. So some of that is unraveling. And with that unraveling, the yen's been quite strong. So these two things, plus, maybe recession concerns, but I think this stuff, as much as anything, that's why the US dollar dropped. And of course, US dollar dropping has been nice enough to do this. It's no coincidence that this chart is basically the mirror image of the US dollar chart. Gold looked ugly there. Q3, it bounced off 1623 times. It's had a great rally since then. It's up to 1930. I think you can thank the dollar for most of that. And does it continue? I think yes. The one caveat that I'll add to this though is, if you think of the Fed doing one or two more little rate increases and then holding it, if you buy into the thesis that inflation is going to keep dropping through this year, what that means is, as every lower inflation print comes in, effectively the real interest rate goes up, because it's just the Fed funds rate minus the PCE rate. So even though it hasn't done it, and interestingly, like that graph I showed you, like second or third slide, where it zoomed up into real rates, had no impact on normally you would expect that to be really negative for gold. Gold didn't care the last 3 or 4 months, so maybe it'll continue not caring. But the only caveat I would have, and to be clear, I'm not expecting a big pullback. I'm actually quite bullish, and I'm not a gold bug, but I'm pretty bullish about gold this year. I think it sees a new high, but I don't think it's going to be straight. I think we'll see some oscillation based on what the real rates are doing along the way, even though up to today the market doesn't care about real rates. Copper, of course, has also done better than a lot of people expected. And again, it's, do you or don't you think there's going to be a recession? But it's a little more complicated than that. Part of this is obviously China reopening. You can see basically from the start of the year, that's China reopening, that spike. It's not clear, it's not completely clear anyway, what Beijing is going to do. They've said they're going to stimulate. I assume they're not going to do the housing market thing again, because a lot of their markets are ridiculously overbuilt already. People I've talked to have told me the focus is probably going to be green energy projects, and specifically tying in green energy projects. So, basically pipelines, high voltage cable, new towers going east to west in the U.S., probably some more public transportation infrastructure. So all of that stuff that's going to require metal use. I don't, the good news and the bad news for metals right now is that there's really not a lot of inventory out there. So we don't need much. Even if you're thinking mild recession, I was more hesitant with base metals a little while ago than I am now, because there's so little inventory out there that even if we have a mild recession, I'm not sure it's going to impact inventories enough. You would see some selling in copper. Just hedge funds will sell it because that's what hedgies do. They just do those kind of trades. But in the real world and in the medium and long term, even the short term, there just isn't enough inventory out there for guys to be shorting that much. And the other thing that's a big impact, and I don't unfortunately see this changing, is geopolitics is having a big impact on metal supply. It varies by metal. Copper, if you think copper, and a lot of copper comes out of South America, there's geopolitical shit shows left, right, and center down there right now. It seems like half the mines in South America got guys burning garbage at their gate. I don't even know what half of them are upset about, and I don't think they're necessarily upset with miners per se. A country like Peru, mining is incredibly important, but it's an easy pressure point. So you add that in, and it looks like there was predicted to be a small-ish surplus of copper this year because of a couple of new mines that started last year. I'm not so sure we're going to get it with geopolitical stuff. So I'm pretty comfortable about base metals. I'm super comfortable medium and long term. I'm comfortable enough medium and long term that I don't really care, honestly, if they dip a little bit in the short term, whatever. Doesn't matter. It's not going to change what I put money into. The same is true for most base metals. To a lesser extent than copper, to a greater extent than copper, probably lead and zinc. They're not really in short supply, or to be specific, lead and zinc concentrates are not in short supply. The problem is, and this feeds back to the energy problems and the grid issues and the insane power costs in Europe. There's a lot of smelters offline in Europe right now. In Europe, you don't think of Europe as being a smelting area, but it is. There's actually a lot of huge smelters in Europe. A lot of them are offline right now because their power costs they're so high, it makes no sense to run a smelter. You can't make money at it. So that might be something where if a bunch of those come online with the power costs dropping again, you might see a little weakness, say, in lead, zinc. It's not going to, I don't think it's going to affect copper that much. There aren't a lot of big copper smelters there. But again, base metals, as long as you got a medium-term view, none of this is going to matter. There's so much demand coming for this stuff, and it's so hard. I mean, I continually laugh when I read articles from, green energy types that are also weirdly anti-mining types, and they're like, we just have to get these guys not to gouge us and grow copper supply by 6 or 7% a year. You heard it here first, folks. That is fucking impossible. Like, it's really, really, really hard. Adding 1% growth year over year for the mining sector is really hard, really, really hard. And people used to talk to us about, there's been periods in the past where you go through these sort of Malthusian periods, like, oh my God, we're going to run out of everything. We're all going to starve and die and freeze. And, I can remember 20, 30 years ago, my late brother and I arguing with people about this, and Dave's comment, and I 100% agree with it, is, guys would say, we're going to run out of copper, we're going to run out of zinc, we're going to run out of this, we're going to run out of that. Dave would just shake his head and go, there's only one thing that matters for supply, that's price. You want 5% growth rate of copper? Sure. At $2, not a freaking chance. 3, no. 4, 5, probably not. 8, okay. Like, yeah, we'll get it to you. It'll take some time, and that's something that's really important to remember. It's a function of price. We aren't literally running out of all these metals. We're running out of all these metals at today's prices. So you want that supply growth, you got to be willing to pay up for it. It's that simple. And that's pretty much all I get to say. The summary slide's just a bunch of blah, 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 blah. So and I'm already over anyway. So I'm going to cut it off here.